There's two things. Number one, don't be afraid to capitalize. Number two, always think long term. This is not a quick fix.
Because he was a forester.
So, is that the best time to plant a tree was 40 years ago. The next best time is today.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's podcast, we're joined by Thomas Cox, and we're going to be talking about one of my favorite topics, IBC. What is IBC? We're going to talk about that today, how to become your own bank. And Thomas is not only helping his clients set up these specific life insurance policies, but he's also using them in his investment strategy. We're going to talk about how he's done that, how he uses them in his business, how he teaches his kids about money, how he's creating generational wealth. This is a great podcast, again, with one of my favorite topics, with Thomas Cox, a financial architect and infinite banking strategist. He's the founder of Cox Capital, and he's helped business owners, real estate investors deploy millions through private lending and IBC strategies that actually build wealth and protect capital. He's previously built and scaled multiple seven-figure businesses in catering, and then he transitioned full-time into real estate and private capital, which we love here. He owns 32 multifamily units across the Southeast. He runs short-term rentals and leaves a private lending network fueling deals across the South. Stay tuned for a fun episode. Thomas, welcome to the show.
Chris, I'm so glad to be here. We had if what is going to be on the show is any indication of what was on the pre-roll, I mean, we had a lot of fun. So I think this is going to be great.
Absolutely. No, this is one of my favorite topics. And, I love what you're doing with the IBC strategy, Thomas, and I'm excited to talk about some of the creative things that you're doing with your clients. But I want to get into your background a little bit. You got a great background. You got a football background. You got an entrepreneurial background, and I think this is really pertinent to IBC because it really is a different mindset that people bring to their financial world, to their financial strategy. And I think that's, entrepreneurs are a little bit different. I love, I used to hire a lot of elite athletes, college athletes, pro athletes. I think that whole methodology blends together. So I'd love to hear a little bit about your background in sports and entrepreneurship and how that really has helped support what you do now with your business.
When you meet athletes and they've done anything other than just weekend warrior stuff, that, as we talked about before the show, that there's been a discipline, there's been a delayed gratification, there's been something in their life that's made them do something in private that has shown itself in public.
Yeah.
And I love college athletes simply because I know what they've done and I know the sacrifices they've made to get to this point of playing in college.
Yeah.
That usually translate into their work ethic.
Absolutely.
And if you can do business with or hire people that have done that, not all the time, most of the time, there's a massive upside to what they can do with you and for you.
Yes. And I love, you said exactly what I always see and why I like to hire athletes is that delayed gratification. Oh. And I see you got Comfort Crisis on your bookshelf. I think, in the world today, when everything's at your fingertips, you can get a date or you can get food and, you can watch whatever show you want to watch on TV. It's like everything's there. You can turn the temperature to 72 degrees and leave it there. It's like you can have whatever you want at your fingertips,
right,
regardless of income level in this world. And, I think that's why sports are so important, especially to our youth today, because it teaches that delayed gratification. It teaches some of these lessons that aren't as available in the world today that we live.
Yeah, there's two things I think that people take for granted, and they're things that don't require a lot of skill. The number one thing is consistency. Like, consistency is where you see the results in your finances, in your spiritual life, in your physical life, in your business life. That's where you're going to see the results. The second thing, too, is a lot of people, and I really believe this, quantity creates quality. Quantity creates quality. So you'll sit there and you'll listen to people and they'll say, I've got 3 businesses that have recently killed it. Yeah, I started 14. Started 14 things, but I had 3 of them that have done really good. I've got a couple losses, Chris, that would blow your mind of things that we just did and failed miserably.
Hmm.
But the wins are typically because we've learned along the way, number one,
Yeah.
and then number two, we've learned from the losses.
Yeah.
So consistency and quantity. When I say quantity, I don't mean working 1,000 hours, even though my college years and probably 10 years after college, the amount of time that I worked is like probably sickening. Because I mean,
Yeah.
you sit there and say, well, doctors missed their 20s because they were in med school. Well, I missed my 20s because I was working in college football. And so being in college football for 10 years, that was a time where I learned the quantity part, but also the quality part. Got to work with some
Yeah.
guys that had been in the NFL, got to work with some guys that just had gotten more about football than I'll ever know. And so being that, all those skills and all those things that I learned had translated directly into the business world. And I
Absolutely.
remember my dad was a coach for 37 years, and I was getting out of football because I felt like the Lord leading us out of that direction. And I remember looking at my dad going, I was 32. I'm like, I don't know what else I could do. He goes, son, you can do anything. Looking back at it, Chris, I remember sitting there thinking to myself even the last 2 or 3 years, all the skills that I created with being a college coach directly translated to owning my own business.
Yes.
And I heard a guy
Yeah.
say this, and I thought this was wonderful. He says, same skill set, different pay scale.
Yeah.
And that's
Absolutely.
exactly what it was for us. It was the same skill set, talking in front of people, selling things, managing people, planning. Like think about those four things. Those four things are what I did every day in coaching football.
Yeah.
And then that's what I have to do every day owning my own business and talking with people and dealing with people. So
Absolutely. And the ability to build a team, to cultivate a team, to have your A players, your B players. I remember one of my mentors was a vice president I worked for in the med device space, and he said, "Chris, I'd love to have 100 of you. You're killing it." He goes, "But I got like 10." He goes, "If you want to be a leader, if you want to be a successful leader," he goes, "you got to be able to work with everybody because you're never going to have 10 superstars on your team. You've got to learn how to cultivate those B players into A players, find the right people, and also sometimes, be honest with the players on your team and
That's
say,
right.
hey, this might not be a great fit for you. Let me help you move into an area that's more successful." So I think you're spot on. It's all about, people skills, building teams, knowing how to do that, patience, and also learning how to work with personalities and talent that might not be at the same level.
That's exactly right.
But it's this timing is perfect for this podcast, Thomas, because I didn't share this with you before the show, but my older son turned 16 this week, and we started our first life insurance policies, our first cash value life insurance, IBC policies, bank on yourself. A lot of people call them different things. Right after I found out my wife was pregnant with my son.
Yeah.
Because I said, okay, what can I do that's going to provide a guaranteed amount of money for my son for college, but also allow us liquidity and different options, with that. I'm intrigued to hear how you started off in the life insurance business and where you learned about this strategy initially.
So I remember getting pitched by a directional, I'm going to just say directional company, a directional insurance company. And I just, it just didn't sound right. It just didn't sound right. And then probably a year or two later, I was sitting with my mentor, Justin Kraft, who owns and runs Nallen Associates here in Birmingham. And Nelson Nash taught and sat with Justin for like, I don't know, 8 or 9 years, and just
because Nelson's also from Birmingham as well.
Correct. Right around the corner.
And just as a quick aside there, Thomas, share with the audience who Nelson Nash is and what he is to this concept.
Nelson Nash is he's a true Southerner. He's a combination of Georgia, North Carolina, and Alabama, and he has got some root Austrian economics.
Yes.
And what he did was he came up with, in essence, the idea of taking whole life insurance and adding more cash to the policies, so that in essence, the way he would explain it is the insurance company is your back office for your bank. And so you load cash value into these policies and then borrow against it, meaning you use that cash in and out just like you would your normal bank.
Yeah.
So he came up with this concept called becoming your own banker, where
Great
you
book.
are
Yeah.
using a cash value life insurance policy as your mechanism to create that own bank, because they give you a guaranteed return on your money, and you can use that money in and out. It grows the whole time, even when it's out being used. So Nelson, in essence, came up and pioneered this concept. But what he also did is he was a disciple of this as well. So
Yes.
he didn't just hide it under a hat. He kept and he started sharing it. And so the last probably 10 or 20 years of his life, maybe longer, 20 or 30 years of his life, he shared this like he shared the gospel of Jesus Christ.
Yeah.
And so and he lived in Birmingham, and my mentor happened to
Yeah.
get in touch with him, and they struck up a relationship, and then our office is primarily built off of that. So I was sitting with
Awesome.
Justin and just like, hey, tell me about this. Because when you own your own business, you got a couple paths you can take. You can your lifestyle can keep up with your income, and it can and you can continue to spend just as much as you make, or you can grow your business. But the hard part about growing your business is when you grow that business, you can't grow at a breakneck speed, because if you do that, something in turn will break. So once you can allocate profits into that business, but you also are going to have these cash reserves that you do stuff with. So,
Absolutely.
and I know this guy's a little bit controversial, but Grant Cardone was brilliant in the way of that he thought about how he worked his business. So everybody thinks of Grant Cardone as a real estate guy. Grant is a sales guy.
He's a sales and business guy.
His
Absolutely. Yeah.
background is sales. He created his income with sales. So what Grant would do is he had this sales business, and every dollar profit that he would make out of the sales business, he would roll it into buying real estate.
Yeah.
In turn, that is what created his empire. All that being said is, if you own your own business, you're going to have these pockets of cash. If you're any good at owning your own business, you're going to have these pockets of cash. And Justin shared this is a way of allocating savings dollars for purposes down the road, for all the things in life, for other investments and things like that.
Yeah.
People confuse it as an investment. It's not an investment. It's a savings vehicle. And
I love that you said. I love that you said that. Let's just underline that real quick, Thomas.
Yeah.
One of the things I've talked to multiple financial planners about this. They're like, oh, these IBC policies are a terrible investment. Life insurance is a terrible investment. I said, whoa. Like, what? Why do you call them? I was like, let me ask you a question. I said, my best friend got a life insurance policy on him and his wife, because he asked me, he said, what do you do? So he went and set policies up with his financial advisor, who fortunately was able to structure well-designed life insurance policies. His wife passed away 3 years later, got a $3 million death benefit. And I said, well, what's his return on investment? He's like, oh, well, that's. I said, would you call him and say, hey, what's your return on investment? I said, no, it's not. It's a tool. It's like you said, it's a tool. It's a savings vehicle. And I think we do ourselves a disservice in the industry when we say, oh, like this is the rate of return in these policies. You can't compare it to an investment vehicle. It's just not. It's not the same thing. It's much more powerful than that, in my opinion.
It's not rate of return. It's volume of return.
Yeah.
Okay. It's not rate, because you'll sit there with people and say, I can put my money in the S&P 500. You're right. You can.
Yeah.
Infinite banking is the truest example of the tortoise and the hare. The hare is going to go up, and it's going to go down. It's going to go sideways. The tortoise is just going to continue on his track. Nelson taught this. There's two things. Number one, don't be afraid to capitalize. Number two, always think long term. This is not a quick fix.
Because he was a forester.
So is that the best time to plant a tree was 40 years ago. The next best time is today.
Yeah.
So with this concept is you have to think long term in everything that you're doing. Justin Kraft sat down with me one day. He said, hey, Thomas, there are other places to put your money to grow your wealth. He says, if you're not going to use this policy the way it's intended to be used, don't do it.
Great point.
And I said, what do you mean? He says, Thomas, when you fund these policies with your savings dollars, with your extra dollars, he said, you need to put that money to work. So we talked about this earlier. I do private money lending. Whether I do it through my fund or I do it personally, I do private money lending. So I will give you a great example. There's about $300,000 in one of these policies that I have. I loan Travis $200,000. My policy's growing at a fixed rate, 0.5%, something like that, 4% plus a dividend. But then I'm going to give Travis 200,000. So I'm growing at 300. Travis has got 200. Travis is going to give me 15%. Now there's a little interest I have to pay back to my policy, but it's going to far outweigh what I have to pay. So I'm growing over here, but I'm also growing over here. That's what Justin was talking about. How do you use and leverage those dollars in order to make more money? That's where the investment piece is. The vehicle itself is not an investment. The process can be an investment, but the vehicle, Nelson used to call it a warehouse. It is your warehouse of wealth. Where is this stuff going to sit? And so the answer when someone says, oh, it's a terrible investment, here's what you look at them and say, you're right. Man, you are right. You're so right. My apartments get so much better return. My hard money fund gets so much better return. My fill in the blank gets so much better return. But you know what? This is the best savings vehicle I've ever found.
Yeah, absolutely. Absolutely. And it's got if something does happen to you, it's got that benefit as well.
Absolutely.
Which creates that the ability to create legacy wealth. And do that, thinking long term, which I think is the other piece of this, Thomas. That's the other thing. Coming back to one of the financial advisors I talked to, he was talking about. I said, well, what do your clients do when if they just have term insurance? He goes, well, they don't need it. By the time they get to like 65, 70 years old. I said, well, what do you mean they don't need it? He goes, oh, well, they're like self-insured. They have enough in their assets and do that. I said, well, are you saying they couldn't use an extra $1 million, $5 million, $10 million, $20 million? He said, no, but they don't need it at that point. I said, so what, are they just going to spend down their savings? They said, yeah, they'll spend down their savings and, within, a 95% confidence interval, they'll have enough until they pass away. I said, wow. I said, that seems like a selfish way to manage your finances if you're thinking more long-term in terms of legacy wealth. What are your thoughts on that?
It's called insurance for a reason.
Yeah.
You don't need car insurance until you have a freaking wreck. So I'll give you a quick story. So a friend of mine, Paul, his dad was overweight and had quadruple bypass surgery. Paul's dad was not worried about dying. Paul's dad was worried about saving his ranch. Here's why. The ranch has been in his house for generations.
Yeah.
Okay. His parents the grandparents get sick and nearly lost the ranch because of long-term care.
Yeah.
Let me tell you something right now. If you want something to suck up your financial wherewithal, long-term care is it.
Oh, yeah. I'm living it right now with my stepfather. He's in assisted living. Yeah.
It's real. So having this mechanism for when you do pass, number one, is a brilliant thing. But understand this. Now, I was going to talk to you about this. Is like how is your stuff set up? So mine is set up to where when I pass away, there's a sum that will go to my wife. But then every dollar after that, I don't know how many millions of dollars, will go into a trust.
Absolutely. Yep.
The trust then will fund policies on my other kids so that perpetual bank will continue to work. Now, we've set up a dynasty trust in our family so that will continue to go on for generations. It's set up for 360 years. So, but like giving your kids to where they can do anything they want, but not so much where they don't have to do anything at all is extremely critical. Number one. Number two,
back to that same philosophy of delayed gratification and everything that you talked about. Yeah.
And number two is when you're doing this, it gives you an opportunity to teach your kids. Yes. This is the way this works. This is what I'm doing. So you set up the policies for your kids. All three my kids have policies. But what we do is we kind of take, and you probably do this, but we take it a second level is we have the food businesses that we own. And the food businesses pay my kids up to the IRS limit of $15,000 and change. That paycheck then goes to fund their policies. So number one, I'm getting a deduction of $15,000 times three, $45,000 off of business income. Then those policies, those dollars are not going to my kids. They're going to my kids' checking account. But then the checking account money flows into their policies.
Absolutely.
And we did the math, and the kids will have about $220,000 of cash value at age 25. Now, we started a little later than you did, but still, It's an absolutely freeing thing, number one. And the thing that nobody ever talks about on policies for the kids is it gives them insurability for life.
Absolutely.
So my
Yeah.
three kids will have insurance until the day that they die.
Yeah.
And if something happens and they get something when they're pregnant and they get a something, or they get Crohn's disease, or they get, diabetes, or I don't cancer, God forbid, whatever,
Yeah.
they become uninsurable at that point. In this situation, all three of the Cox kids, they're insured for life.
Yes. And that's a great point. And if you're listening and you're like, I'm young, I'm healthy, I don't need to worry about it, that's the best time to get this. And you can even do things like convertible term insurance, where you can say, well, I maybe don't have the finances to set up a policy where I'm funding it at 10, 50, $100,000 a year, but there are ways that you can get around that and maintain your
Yep.
insurability so that you don't give up that opportunity.
Well,
Which
we
is
did a policy on a couple, and the wife makes a very good living. The
yeah,
husband does fine, but he doesn't make quite as enough as the wife does.
yeah,
And they're one of those households that keep finances separate, which again, that's a whole different topic by itself. You can
yeah,
or can't do that. But we set up a whole life policy on her with an IBC function.
yeah,
But we put term on him because at some point his income will increase, and we can convert that term.
yeah,
I do that on my wife. I did that on my wife recently. So like we've got a windfall coming here in a little bit, but I went ahead and put the term insurance on her now so that
in
in 6 months, 8
anticipation.
months, 9 months, we can get that, because here's the thing: every year that you get older, insurance gets a bit more
Yeah.
expensive.
Yeah. No, I love that. And you brought up a couple of really good points there, Thomas. The one I want to go back to though is, teaching your children. And this is something you mentioned, kind of blending the two concepts you talked about, running your businesses like a corporation where you're saying, hey, I'm going to keep capital reserves in place. But the other thing that I think a lot of people don't think about is teaching your children the cost of capital. And when we say, hey, here's, let's take your $200,000 example. Let's just say you give your children a pot of money, $100,000 to $200,000 for college, and say, oh, I'm giving them this gift. The challenge is they're going to spend it because they don't appreciate where it's
Sure.
coming from. Whereas if your children take that same $200,000 and they say, well, I can borrow this for college, for a business, for an opportunity that I have, they're going to have to borrow that at 5-6% from the insurance company. Now, some
That's
people say,
right.
well, that's just stupid, Chris. And now you're paying yourself interest. They're negating the fact that you get the guaranteed
Yeah.
dividend every year, guaranteed return plus a dividend every year. But I think that's so valuable. When I was in business school, we learned about the cost of capital. A business is going to say, okay, what's the net present value of this project? How does it compare to our cost of capital? Because we could put that elsewhere. If you're using these policies, you're basically creating the opportunity and the structure like a corporation does, like a real business does, to teach your kids that same principle.
I feel like every business owner out there has got to have some sort of mechanism through which they can do this. So there are so many ways we can teach our kids. The best way, and to be honest with you, is windshield time. Going to lacrosse practice, going to volleyball tournaments, whatever.
Yeah.
We spend some windshield time teaching our kids.
Yeah.
But the second thing is we write off just about every trip that we do. Because, like for example, we're going to the Dominican for spring break. And we're going to take that time. We're going to take sections of that trip, and we're going to sit down and we're going to put things up there and say, hey, this is who we are. This is who we are as a Cox family. This is what we believe. Here are the finances. This is what mommy makes. This is what daddy makes.
Yeah.
This is how we do things. And we explain, but we do it in doses. We can't have a 6-hour board meeting.
Yeah.
They're kids.
Yeah.
But we sit in doses and explain certain things about who we are and what we do and how things work, how things would work when daddy died, and so on and so on and so on.
Mm.
Well, number one,
hard conversations, but very, very,
very hard conversations.
Yeah.
But we drip these things into them so that, God forbid, if something did happen, they know, number one. But number two is they understand how money works. So there's two things that our parents, and you're about my age, two things that our parents didn't talk about. Number one was sex. Number two was money.
Yep.
I don't care how perfect your parents' finances were, most of the time they didn't talk about those two things.
Yeah.
If we can stay ahead of the curve on both, and again, the other is topic for a total another podcast. If we can stay ahead of the curve on the financial part,
Yeah.
we can create the knowledge about those things. Because here's the thing, my three kids have totally different thought processes around money. 17, 14, and 10. One of them spends it like a 50s gangster. As soon as she gets it, it's flying out of her pocket. And then another one is like, he's the conserver, he's the saver. He's like, Dad, put my extra money in my brokerage account. Make sure it goes in that account. Yes, sir. Like, so like teaching them and making sure they're all at least on the same page. Now, here's the thing. You're never going to, you can't push a rope. You're never going to take someone's DNA and totally change it as far as how they think about money. But you can educate them and say, okay, yes, you can go spend, because some of people are more spenders than others. You can do that, but you're going to do that with this pot of money because this pot of money is here. This pot of money is here. So we are, with the money that they get from birthdays and when they work, we break it down this way. We go 10% for Jesus, 10% for saving, 20% for investing. So we're at 40% at that point. We take the other 60 and we say, live off the rest of it.
That's great. Yeah.
And there are some people that will say 10% for living, 20% for, 10% for Jesus, 20% for investing, 20% for savings, and 50% for living. Either one is totally fine. Just depends on what that number wants to be. Yeah. Number one, we always give first. That's a creed in our family. It's biblical. We always give first, but then we can teach our kids that 10, 20, 20, 50 rule and just get them used to it. Get them used to doing it.
Get them used to doing it. And that's scalable. And our rule is very similar. And, we put that into effect, and people, as our earnings grew, our spending grew, but we allowed our savings to grow commensurate with that. And then it's very comfortable. So you can scale and then it's fun. I always called my life insurance policy premiums my savings tax. So
that's right.
My money would come in and, spending nearly 2 decades in pharmaceutical and medical device sales, I did well from a commission basis, but I'd have really good quarters. I'd have lean quarters. And it was fun because the money would come in, my mortgage payment would go out, my life insurance premium payments would go out. We didn't have a ton of other debt. And then whatever was left, I could spend it. So that was fun because what was left after my savings and investing, then we got to spend it without guilt in doing that.
Sure.
So I love your strategy, Thomas, in doing that. Yep. I do want to shift gears because I think this is really, really important. And you did mention this. You said that Justin said to you, hey, if you're not going to use these policies, Thomas, then don't set them up. And you've really perfected this aspect, and it's something that we teach our clients as well, is blending the infinite banking concept with investing. Can you share how you've done that and how you've used it to really create this really amazing compounding effect?
Yeah. So I would say the first way that we use is with hard money. Yeah. We do a lot of hard money lending with that.
Great option. Yeah.
Like I said, if there's $100,000 in the account, we loan $200,000. So we're still making our percentage and our dividend here. But then go ahead.
So let's break this down because this is fantastic. Yeah, sure. So you lend your friend Trent, was his name?
Travis,
sorry. Yeah. Yep. So you got $200,000. You put it into your policy. Let's break this down for the audience, for those that don't understand it. So you put the $200,000 into your policy, and then you have it in the policy. What are the mechanics of that? How much interest are you paying? What's the dividend you're receiving? What's the interest you're getting on the loans? What does that look like for somebody?
Yeah. So I really only want to pull out about 75% of my cash value just because from a safety standpoint. So we've got a policy that over time it's been building. So our cash value right now is about, in one of our policies, is about $300,000. So there's $300,000 that's working at 4% plus whatever that dividend is. That dividend is between 0.5 point and 3/4 of a point. Now, obviously, the longer the policy grows, the bigger that dividend gets. Yeah. So let's just call it 4.5%. So we're growing at 4.5%.
Very modest.
300,000.
Yeah, we've seen
3.5% over here. Yeah. Then I'm going to borrow $200,000 from this policy. Even though I'm borrowing this money, it's still growing at $300,000. I will borrow the 200, and then I will let Travis use it. Now, here's the thing. Let's talk about this interest. That interest rate, 4%. It's fixed. So I'm gaining at 4.5 on 300. I'm paying interest on 200. Mm-hmm. Now, the thing about infinite banking is the flexibility. Understand this. The flexibility that we have with infinite banking is wonderful. So I'll give him that money for 6 months. I won't make a payment. I won't pay anything back towards my loan. When he pays me back and he pays me $230,000, let's do the math, 200 times 15%, $30,000. He pays me $230,000. Okay. I've made 30 grand. Now there's always a cost. There's always a cost. So what I'm going to do at that point is my $200, it cost me 4%, but it was out for 6 months. Okay. So it's only really costing me 2%. Yeah. So call it $4,000.
$4,000, yeah.
So I made $30,000. I had $4,000 of expense. So I made $26,000 off the loan. Oh yeah, by the way, I had my $300,000 over here working at 4.5%. So whatever that dollar amount that I made is as well.
Yeah. Yeah. No, it's beautiful. And the beautiful thing is that money that comes back. We used to do it with spec homes. We'd borrow, say, $100,000 out, buy a piece of land. And you mentioned the flexibility. The life insurance company doesn't care when you pay it back. Like,
oh, they don't care.
They don't care. And you could pay it monthly. You can pay it in a lump sum. You actually never have to pay it back if you don't want to, because the death benefit, we don't.
The death benefit will take care of it.
Yeah, that's not necessarily the best use, but it's very, very flexible. And you can create so many things. You can create guaranteed income in retirement. You can do long-term care riders. You kind of alluded to, Thomas, if you need those sort of situations, it's so powerful what you can do.
I'll give you another great example. My partner Mike, he had about $400,000 in his account, and his wife was in the teacher's lounge at school, and one of the other ladies came in and said, "Oh, both kids are gone from Auburn," and so she had two daughters over the course of 8 years that went to Auburn. Yeah. And when they got there, they bought these two sets of condos. They bought a 2-bedroom and a 2-bedroom. So they had 2 units with 4 bedrooms total. Yeah. And she said, "We just need to get rid of these places." She said, "We love them, but we don't have any more kids down there." And so Mike's like, how much they found out how much they wanted for them. I'm going to use a round number. It was like $300,000 for both of them. Okay. Yeah. So Mike bought both of them. He pulled $300,000 out to buy these 2 condos. He gets $2,200 for one and $2,200 for another. So he's getting $4,400 for these condos. Check this out. Here's the thing that people don't know about infinite banking and the way that interest is accrued. It's called daily average balance interest. So when you pay back anything towards that loan, every dollar goes towards principal. You pay the interest on the back end. Okay. I could go into this nitty-gritty detail, but we don't have time to do that. So he's going to, listen to this, Chris. He's going to pay these 2 condos off in 7.5 years.
Instead of 30, for instance.
Instead of 30. Yeah. So the power that this thing has, and the ability that the things that it can do for you from a wealth standpoint is astronomical. So there's 2 different ways that we did it. One was on loans, one was on purchasing real estate. Yeah. And when leveraged properly, it's a great tool.
Oh, it's phenomenal. Yeah, we've unfortunately, it took us a long time to learn, because the first agent we worked with, life insurance agent, didn't really teach me the principles. He's like, "Oh, you want to invest $100,000, just do it out of cash, out of your policy. It doesn't really matter." Thomas, it cost me several $100,000 in ultimate cash value in my policies, because I wasn't running that through. But reading Nelson Nash, studying, learning the different ways to do it, we run almost every dollar through our policies now.
Wow.
And it's incredible, the power. And, we were talking about some of our mutual friends. Some of my friends have like 3 or 4 dozen policies, because they'll start them every time they have these windfalls or these cash values and doing these things. Thomas, we could talk endlessly about different examples and doing things, but I'm sure this has stirred up a lot of thoughts in our listeners here today. You've got some phenomenal resources I was going through before the podcast. You've got your own podcast as well.
We do.
If our listeners want to get in touch with you and learn your strategies and how to set these policies up, what's the best way to get in touch with you?
Yeah, our website is thomascox.co, thomascox.co. And then we've also got a link so there's people out there that love to read, and there's people out there that hate to read. And so because the best thing to do if you're going to learn anything more about infinite banking is to take Nelson's book, Becoming Your Own Banker, read the book, and then from there, we can extrapolate those. there's a lot of people out there, Chris, that don't like to read. So what Mike and I did is we created a 3-part video series that really, on the third video, really is tailored to investor, or the business owner, or the high W-2 person. So you're going to fall in one of 3 categories if you're going to even consider this. Yeah. So we created this 3-part video series, and that's at ibc.money. That's ibc.money.
Perfect.
And
we'll make
you
sure
go
this
there.
Is all in the show notes here.
Yep. And you can go there and see and learn more about infinite banking can work for you. And here's the thing, Chris, it's not for everybody. It's not. Yeah. And you know that you deal with people every day that I told a lady last week, hey, ma'am, this is probably not for you right now. It can be in the future, but today it's not. And so that's a great resource for people, and we have hundreds of people that view that all the time.
Yeah, no, it's fantastic. And as Nelson Nash said, you got to meet people where they are, when they are. And, you know, I love it. I love what you're doing, Thomas. Thank you for sharing all this with the audience. You know, you got the same mission that we do, and dude, you're staying in great shape. I was looking at your picture here online when I pulled this up. So I know you don't coach and play football anymore, but you know, I know you're watching out for the health, so you can spend those years with your kids and your family and keep the message going as long as possible.
That's right. There's two things in life you can't neglect. One is your health, and the other is your wealth. And if you can keep both of those parts, and the health is in all areas of our life, whether it be mental, physical, spiritual, all that stuff. So your health and your wealth, if you can keep those things in line, make those a priority, you'll be successful.
Well said. Thomas, thank you so much for your time today.
You got it. Thanks, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.